All right, let's get started. I'm going to say welcome, everyone. My name is Diana. I'm a 2017 SOM alum, and I'm also the head of research and sustainability for the Global Blockchain Business Council. It's really my pleasure to welcome you here to our webinar today on the crypto market crash and the role of safeguards like insurance. And we're joined right now by Jay Gadansky. He's the founder of a startup called Evertas. And he's also a Yale alum. He did his PhD in electrical engineering. So welcome, Jay. Introduce yourself.
Hi, all. Hopefully my audio is coming through. It's always that moment of fear and trepidation thinking of this. I'm an electrical engineer by training, ended up as the first blockchain hire one of the world's largest banks, and then at the world's largest custodian bank. Was very heavily involved in enterprise blockchain, starting in 2015, and eventually, in addition to kind of technical diligence, risk diligence, and a bunch of legal and regulatory issues, we started getting questions around insuring crypto assets, and so there wasn't really a good solution in the market at that point in time. So I started Evertas with my co-founder Raymond Zalles. And we are the first company that's solely focused on insuring crypto digital assets and blockchain infrastructure. We are the only Lloyd's cover holder for crypto asset insurance. We actually got the first company to get regulatory approval to have a digital asset insurance carrier anywhere. We maintain the only claims team. We are we handled the first crypto claim that was ever made. I think we're going to be. It looks like we'll be involved in the first crypto claim for a large insurance organization. And we've been focused on kind of risk management through insurance since the beginning. So really happy to be talking to you, and looking forward to doing this in person in New Haven soon.
Yeah, you're really pioneering a lot of the solutions and addressing a lot of the risks in crypto markets. And we've seen there's been a crypto market crash recently, and basically how the recent market collapse seems to reveal a lot of issues within the crypto market, including stablecoins. And discussing stablecoins, can you unpack that a little bit and how that unfolds into greater market issues in current events and recently happened?
Yeah, I mean, I think I'm sure, honestly, many of the I'm just an engineer, so I'm sure many of the management students at SOM probably have a greater grasp of kind of maybe the economic patterns that unfolded here. But essentially what happened was you had a lot of over-leveraged entities that had a lot of exposure, and there was kind of a bit of a panic or a run, and people trying to pull out their assets they couldn't meet their obligations. This particular series of events that unfolded started with a stablecoin. So you had, I guess before getting into this, what are stablecoins and why do we care about them? And if you want to tell the time, start building me a clock. And so, the idea is cryptocurrencies tend to be fairly volatile, particularly compared to fiat currencies. Typically, the US dollar is the kind of the typical unit of account for most of finance. And there are benefits, a number of benefits that are kind of crypto specific, kind of like the crypto DeFi space, and then more generally to having a stable unit of account that can be traded on chain. This could be kind of stable for, typically this is done against fiat. You could do it against commodities, you could do it against other cryptocurrencies, but for the most part, people are using stable coins against USD or other, similar currencies. And what's interesting about this from a non kind of crypto anarcho-capitalist perspective is if I have I have stable coins in USD and you're in the EU and I need to pay you, instead of having to go to my bank and buy, dealing with the wires and going through correspondent banks, all of whom take their cuts and they only operate during certain hours and it takes time to clear. I can go to a decentralized exchange and I can say I'm going to put in maybe I'll use pounds since it's nearly a parity of the dollar. But I'll put in one USD, and I'll send you £1 worth of a stable coin, and so you get paid in your in a local currency, which could be useful for remittances, could be useful for supply chain and trade finance. Sorry, Diana.
No, I was going to say it's interesting because we would be introducing a new era of the internet of value, where we could send money across borders to our friends directly peer-to-peer, just like we send an email.
Yeah, I mean, like I said, as a custodian bank, so I actually spent a lot of time looking at like foreign exchange and specifically like kind of correspondent banking and nostro accounts and things like that. It's kind of a mess, right? If you think about the chain of intermediaries that are needed for sending payments. So there definitely are benefits, in a very strict kind of business sense of being able to operate 24/7 and reducing friction in number of intermediaries and the risk that comes with that. I think there are strong arguments to be made around kind of remittances and kind of financial inclusion accessibility. We talked about this, I guess, a bit on Tuesday, but this is that's probably a whole nother webinar topic, and so I don't want to go necessarily too far afield. Yeah. But within the cryptocurrency space specifically, the benefits of stablecoins is that you can have a ability to do transactions that go back to a real world asset that people can use, to buy a cup of coffee or whatever, without having to deal with, I'd say, a lot of the friction of kind of centralized intermediate. Well, with kind of off-chain intermediaries, I would say, right? And so it's very helpful if I say I want some Bitcoin, I can do that exchange completely on chain, and this is particularly important when you think about DeFi or decentralized finance, where we're going from the era of I want to buy Bitcoin, so I go to a site that allows me to make a forum or something like with Bitcoins, and I try to find someone and say, hey, you want some Bitcoin? I got some cash. Let's do an exchange. Either meet up or do electronically. And then that kind of scaled up a bit, quite significantly with centralized exchanges, so your Coinbases, your Geminis, right, things like that. And then with DeFi, the idea is that you can do everything on chain, and that would include kind of these sorts of exchange transactions. So it's helpful.
Also introducing here the importance of maintaining transactions on chain, because just to make the audience aware, some people are newer to the blockchain space. The value of making transactions on chain is that we benefit from the potential of almost real-time clearing and settlement, and the transparency where all the transactions get recorded, and really truly direct peer-to-peer transactions without intermediaries, which reduces cost a lot, as opposed to having to go back and forth between the blockchain essentially and traditional financial markets, which would add additional frictions and potentially fees, right? So when transactions are completely on chain, it keeps it within the same system, and you can maintain the benefits of these greater efficiencies, right, from a financial market infrastructure, which you know about very well, Jay.
No, I appreciate it, because you're taking my muddled thoughts from my addled mind and turning them into something cogent and hopefully educational. The other benefit to this, let's be honest, this is an anarcho-capitalist experiment, is the idea that you wouldn't, in theory, have sanctions or kind of government intermediaries that can stop the transaction. So obviously that has some appeal from an illicit standpoint, but I think we've actually seen the markets, even the DeFi markets, adapt to the sanctions regimes and compliance regimes that are in place. I think it actually has much more value in kind of preventing bad actors, right? Whether it's corrupt government officials, et cetera, or corrupt banking entities from, preventing kind of from imposing capital controls, right? If you think, I think like back during the financial crisis, I think people were like trying to, in like Greece, were using like crypto payments to, keep their AWS servers for like their businesses online for the 2 weeks they weren't able to pull out, foreign currencies. So I think that just the reduced number of intermediaries that can interfere with the transaction, I think, has benefits, and beyond just the kind of reduced cost, reduced friction, and the ability to kind of send funds directly to people.
Right.
But anyway, so this is why stablecoin people care about stablecoins. It's a very long-winded thing. They're very useful, and you know, from both an ideological and from a very practical standpoint, and they have lots of benefits.
Yeah,
so
there's a lot of this on one hand, but on the other hand, there's been this whole market crash. What does this have to do with the whole crypto markets?
Right.
There's been a model of algorithmic stablecoins that are not backed by any tangible reserves, but basically a algorithm that
this is the winding road, and I appreciate the patience of the audience. I do see Aleve Mine has their hand raised. I don't know.
Yeah, we are taking questions. If you have questions, please submit them in the Q&A chat, and we'll have time for Q&A at the end. I forgot to mention.
Okay. And so there are different ways of doing stablecoins, right? So like the easiest and most obvious one is like I put $1 in a bank account, and you know the bank the entity that controls the bank account issues a stablecoin, right? It says, okay, here's $1 USD worth of value. And so this is like how Tether works, or USDC, more or less. I mean, it might be, you know, commercial paper or, you know, treasuries or something, you know, liquid and low risk. But long and short of it is, for every dollar that's being issued, there's a physical dollar sitting somewhere. So that's kind of a fully backed, or, you know, fully reserved stablecoin. You also have stablecoins that are based off of kind of other assets, and these tend to be over collateralized. So, hey, I want $1 USD worth of value, so I'm going to deposit $1.50 of Bitcoin into, you know, a smart contract, and I'll issue $1 USD of value. And if the market, you know, is volatile, and, you know, the value of my 150 becomes, you know, $1.25, I either have to deposit more Bitcoin to get it up to that collateralization level, or essentially have a margin call and liquidate it, and, you know, use that to try and keep everyone whole. So that's another model of doing it over collateralization. There are then you kind of get into where we run into trouble, which is algorithmic stablecoins. And the idea is we're going to create an algorithm, and it's just going to maintain its value because the algorithm works. And this gets to Terra and Luna. And so you had a stable coin, and the idea was that, you know, Terra would always be worth $1. And so if Luna becomes more valuable, and it would be also tradable 1-for-1 for Luna. So if Luna gets more valuable, people could essentially say, oh, there's an arbitrage opportunity. I'm going to trade my 1 Terra in for 1 Luna, and I'll make some money. And if, you know, Luna is under $1, well, my dollar stable coin, yeah. So there's basically an arbitrage opportunity there. It's if you were, when you deposited money into Terra, it would burn Luna, and when you pulled out, it would mint some more Luna and burn the Terra. And so the idea was that this would kind of maintain its balance. What had happened was, and there are some benefits to this. The most notable one, I would say, is, well, in theory, there are benefits. I'd say the most notable one is the fact that you're basically not touching the US financial system, which I feel like, if you're trying to avoid sanctions, you know, which is, again, you know, not trying to be overtly political or radical here, but if you actually read like the Satoshi white paper, it's a very radical document in terms of what it's a political document, much more than an economic one, I'd say. And so that's kind of always part of this conversation in kind of the crypto space. And the true ideal is that you're literally eliminating any intermediary. So all the value is sitting on chain. You don't have to worry about a bank run or bank shutting down or sanctions or corrupt government. Everything's sitting on chain. This is kind of, you know, the white whale maybe for a lot of people in cryptocurrency, where it's like, we want to really just have everything sitting in this purely digital form. We don't want to be sitting there worried about whatever happens in the analog world. The problem with it is that algorithms, you know, work for any parameters, models break down, and that's exactly what happened. Someone realized that they could basically put pressure on the Luna Terra ecosystem. They shorted it. They did a trade. They made a lot of money, and there was a flight to safety. Mm-hmm. Now, a lot of people had exposure to Luna because Luna was meant to be, you know, the idea was that as this ecosystem got used, Luna would appreciate in value. And so people were investing in it speculatively. At the same time, to juice kind of returns and interest, there was a protocol called Anchor, which offered a 20% annual return.
Yeah, I think. Of leverage. That's where we've seen leverage. And that it was basically an alternative, right? Where people could deposit money into this protocol as opposed to depositing money in a commercial bank account and make 20%, which is outrageously high, right?
Yes. And so friends of mine used to use the phrase free, but at what cost? And so your 20% was free, but at what cost? And so people, so you have two things, right? Which is you have this Terra Luna ecosystem, which a lot of people had exposure to. You also had this protocol that was being used to juice returns for other people in the general crypto ecosystem. And so you kind of had two problems. One is people just in general had a lot of exposure to Luna. And a lot of them to juice returns, these tended to be more kind of centralized lending type platforms. So you may have heard about BlockFi or Celsius or things like that. Also had a lot of exposure to the Anchor protocol, either directly or indirectly. And this is a bit of a tangled weave, and it's a web that's been created. And I think we're going to see some very interesting postmortems as we get the full stories. But anyway, so Terra, and Luna crash. Anchor protocol goes kaput. People flee to safety. This creates a feedback loop. They tried to bail out Luna and shore it up with some more investment to show that it was, going well. It wasn't enough. The market's lost faith. The thing kind of continues to crash. People are trying to get out. People that are invested in these companies are trying to get out, and their customers are trying to get out of them.
A lot of people lost a lot of money, and there was not a lot of recourse.
Yeah. So you started having a lot of people that were leveraged, and this is where 3 Hours Capital kind of comes into the story, which is that 3 Hours Capital was, while there's a lot of transparency and there's a lot of visibility of what was going on chain, centralized off-chain intermediaries can be as opaque as they are in the traditional financial world, and arguably far more opaque because there isn't, sort of established industry norms and kind of regulatory oversight, right? And so what you see happening then is 3 Hours Capital was over leveraged with multiple entities. These entities want cash back. 3 Hours basically collapses because they don't have enough. They were overexposed. They have no way to make their debts. A lot of people are exposed to 3 Hours Capital. Now they can't make
their own payments.
Yes, and then there's other complications where you had people that were sitting in this Bitcoin. I mean, this is kind of in the weeds, and I would we could probably spend days on this, but there are a number of good articles. Bloomberg has a really good article about 3 Hours Capital. There are a couple of good kind of postmortems on the collapse of Celsius and Terra and Luna as well.
Which Celsius, I want to draw the difference here. Celsius actually was also a lender where people could deposit their value in stable coins and make an interest rate, which was higher, like a quote unquote.
So there were a lot of companies that did this. Like BlockFi had like an interest account, an interest-bearing account, which the SEC, there are state securities regulators went after BlockFi on. They actually had just settled that right before this whole debacle happened, where they kind of went down to zero, where they basically got bought for pennies on the dollar. We actually share an investor at BlockFi, and I have friends there, so that was kind of an interesting thing to see. Celsius, by the way, positioned itself as they have the Celsius protocol, and they kind of positioned themselves as some sort of DeFi thing. They were just a centralized entity. They weren't, they were lending things for returns, and
decentralized DeFi lending.
So and so you ended up in this basically these interconnected things, interconnected systems, right? And it had similar we've seen in other financial panics and financial crises. You had contagion, and again, I'm sure your audience members are more well versed in the histories and mechanics of this than I am. But what was interesting is you started getting these minute details where people in anticipation of the Ethereum merge, which would move it from proof of work to proof of stake, were staking Ether, but this became illiquid. And so it was trading because it was locked up until after the merge. And so it was trading at parity with ETH because it was generating return for, presumably for staking. And then all of a sudden people wanted liquidity and they couldn't get at it.
He's coming back. But I guess right now, what really I'm going to say, I hope you can hear me, but it's interesting to me how we've seen in the crypto market growth, the role of leverage. And we see that's kind of reflective of traditional financial markets, which really run on credit and the role of debt, right? And in crypto markets, as they've developed thus far in this crypto market crash, the role of leverage has been substantial. And we've seen, like Jay was mentioning, alternative models that are either completely decentralized as part of the DeFi ecosystem, which is decentralized finance, where you have these very decentralized projects that are building applications as alternatives to the financial system, one of which was lending. And people could make a lot of money by just depositing their money and largely over collateralizing it. And also centralized schemes like BlockFi, like Celsius, and Celsius had a lot of trouble because of this over leverage. And then tying it together, the role of Three Arrows Capital is just an example of many others where there was probably a lack of consumer protections. People lost a lot of money when Terra came down. All these projects were very interconnected, and it led to a systemic consequences, right? So really, moving forward, Jay, how does one manage risk, and what are the takeaways from all of this?
Yeah, I mean, it was very, I mean, it was kind of an interesting thing to see happen. I think, one of the interesting things is that, like I said, that you had kind of all these like different things that were locked up, and you can read about like the Grayscale Bitcoin Trust and how it started trading at a discount compared to Bitcoin at one point, and so there was like these, again, there's these people making long bets, and they basically couldn't get the liquidity they needed to. What's, I think one of the most interesting things about all of this was that, as this collapse was happening and people were having these liquidity issues, you saw a lot of the DeFi protocols get paid back first. And the reason why was because people were going to get slashed or lose their assets if they didn't make certain payments, right? And so they said, "Oh, we'll make these payments and free up our, what we staked, basically get back some of our assets." And so it's interesting because everyone says, "Oh, like this shows that DeFi doesn't work," and the entities that all failed were centralized entities for the most part. And the thing that was purely on chain that failed was, in fact, Luna and Terra, but the actual companies, the entities, right, that you've read about in the news, whether it's BlockFi or Celsius or Voyager or Three Arrows Capital or Genesis had some liquidity issues, right? Those are all centralized entities that had the exact same problems that every financial entities have had forever, right? But the DeFi protocols got paid back first, and the rest of them, everyone else is fighting out in bankruptcy court. And it'll be interesting to see how that kind of unfolds. And so, to your point, you said, well, you have all these interconnected issues, and how do we manage that? I mean, I think, as with many things, transparency is helpful. And so, like, one of the ways that Three Arrows Capital was able to cause as many issues as it did was they were reusing collateral with multiple, and they had a good reputation, and they were reusing collateral in multiple different places. And so now multiple entities had exposure to this one company, which was overexposed to this one project. And the house of cards kind of falls down, right? It's like, when you say, "Oh, I want 3 sources for something," it's like, well, I told you, I told someone else, and I told a third person, and they all go back to the folder. Yeah. And I mean, you can, I guess, for a somewhat historical example at this point, is like, if you want to look at like the Iraq War and WMDs, you're like, "Oh yeah, everyone, we have like tons of great intelligence on this." Like, it's all like one person to kind of make things up. There were obviously a lot of issues there, but what this comes down to is, I think, first off, this is one of the reasons why you're starting to see regulation or discussion of regulation on stablecoins, whether it's kind of just outright outlawing algorithmic stablecoins or requiring that they're fully backed. There was this concern with Tether at one point. The New York State Attorney General went after them and said they were kind of misrepresenting their assets, which they did for a period of time. Of course, the irony was that basically the feds had locked like a payment provider that owed them money, which is what caused this liquidity issue. But so you're seeing an effort to kind of manage the stablecoin risks and prevent this sort of kind of contagion from coming up again. And I think you're seeing people looking to apply traditional, I'd say, financial risk management best practices to the industry. So it's interesting to see how this unfolds. I think, it is interesting, like you said, that centralized entities had big issues. The decentralized ones got paid back, and I think what you're seeing is a healthy kind of market correction, in that I think a lot of bad actors and poorly run entities, did feel the pain and are reforming or are out of the space. The flip side of that, of course, is that there were a lot of people, individuals and retail investors, that did get hurt and lost significant sums of money. And so we have to I think in general, everyone's like move fast and break things, but we should recognize that the things we're breaking may be, people's financial livelihoods. And I think the crypto industry has not had the best record of being mindful of who the end users are, as the financial industry did in 100 plus years ago, and we've seen regulation come into that. So I think that's why there's a lot of interest in regulating and kind of maybe getting a grip on some of the practices of the crypto industry.
Yeah, and also regulators jumping in there's more of a consensus on the need for standards, best practices, requirements, and also solutions, different levels of safeguards. And you work in the insurance industry, that's what you specialize in. How does this tie into insurance?
Yeah, it's interesting because insurance is fundamentally a risk management business, and it's kind of an interesting thing, right? Because insurance companies don't make money if they're bad at their jobs, right? So if you're bad at managing risk, you don't make money as an insurance company, and you will probably go under. At the same time, you don't make money if you don't sell anything either, which means that the industries that you're catering to have to be thriving and have a need for insurance for an insurance company to be viable. So you kind of have to have this balancing act where you want to ensure that the industries you're insuring are in fact successful because you want them to buy insurance. While at the same time, you want to make sure that you're managing risk so that way your business all stays solvent. So you have these kind of tensions. And what's unique about this is that it makes you most uniquely qualified, and the insurance industry most uniquely capable, arguably uniquely capable, of allowing for responsible growth of an industry. And so kind of, if you look around the world and you think about fire safety or auto safety or consumer product safety, almost all this has been driven by the insurance industry, right? If you're in the US and you buy a car, no one cares what the National Highway Traffic Safety Administration, the government entity, no one cares about what their crash ratings are, because those were determined and it's slow to change and determined in law or regulations, and no one cares. They care about what the insurance crash ratings are, because the insurers collect a lot of data on auto accidents. They don't want to pay out large auto claims, which obviously are aggravated by injury and death. And so they're really interested in having safe cars on the road and people driving safely. And so their crash ratings are what people care about, because that's what they specialize in. And you see that across the board. And I think that's going to be true for crypto as much as anything else. What's interesting about insurance companies is that because of this tension, we are, I think, much more capable and much better able to reduce risk, professionalize, and mature an industry than a regulator is. And a lot of regulators recognize this. This is why typically they'll just require some form of insurance to operate in a regulated field. The SEC required public companies to get cyber insurance, I think about 10 years ago now, because they realized there was this issue with companies, having cyber breaches, and they thought that would be helpful. And it was obviously not as helpful as it could have been. And we're seeing a large correction in the underwriting of the cyber markets now. But at the same time, a regulator, for the most part, it depends on the regulator. The regulators that are very kind of pro-business and they want to see kind of industries succeed and innovate. There are a lot of regulators that are just parochial and they just don't care. And they're just like, well, I just don't want people getting hurt. Kind of having the fallacy of discounting opportunity cost, right? Where like, well, people are getting hurt because of regulations in some cases, right? Or there are deleterious effects and feedbacks to everything, right? And sometimes that's lost, right? Like, really simple example, right? Onerous requirements for going public has reduced the number of companies going public. So they're staying private far longer, which means that more and more wealth creation is being held in the relatively few connected insiders in the form of venture capital providers, sovereign wealth funds, and their investors, and not general retail isn't able to respond, isn't able to access that. And that's honestly part of the reason why you see so much activity in crypto. But again, so that's a separate conversation for another time. We, as Evertas, we're crypto natives. We want this industry to be successful. We are, I've invested the majority of my professional life in this industry, and we are believers in the ecosystem. We understand at a technical and ideological level, and at a kind of commercial level, and a personal level, what this can do. At the same time, we recognize that there can be a lot of harms. And so we spend a lot of time thinking about how do you manage those risks? And those risks are manifold, right? There are technical risks, right? Whether it's a smart contract that has a bug in it, or hardware wallet that's poorly set up, or an algorithm that was poorly implemented. Right? It could be the right thing.
Risk changes as opposed to traditional financial system. You're no longer dealing with just counterparty risk, which is another person, but you might just be dealing with a smart contract and all the technical risks that you add to it. So what can you unpack further, like what types of insurance there are for what types of risk?
Yeah, I mean, I would say maybe the technical risks are greater, but I think people are I think we're starting to recognize how fragile some of the technical infrastructure in the traditional world is. But yeah, I certainly think this is a newer technical risk, and there's certainly many more of them, particularly in certain applications like bridges and such. Risk is fast changing. That's actually why. That's why I think regulators are always going to be behind the 8 ball in this, and I think that's why they're going to default to their traditional stance of, oh, just have insurance, plus a few other kind of reasonable best practices. We've seen this, right? Like Hong Kong was actually very aggressive on this front. We're seeing other global regulators and regulatory bodies, passing requirements and rules around this, because they want someone who's sitting there and who's financially and economically incentivized to make sure people aren't doing the wrong things, and who are able to respond quickly, right? You want to change a regulation in the US, it's what, 6 to 12 months, just to get it published in like the Federal Register. From a technical perspective, you have, counterparty risks, right? As you always do, but like you said, those counterparties can be, code and not people. I think in the long term, this is probably going to be beneficial as kind of, I hinted at before, right? The DeFi protocol got paid out first during this. And I think when you get to a point when you have kind of a more mature technical ecosystem, you have kind of very standardized kind of smart contracts that are code that's being used. I think the technical risk will go down significantly. I think people will recognize that, oh, I don't have to worry about, my counterparty stealing the money or not fulfilling the part of the contract because this is algorithmically kind of being enforced. That's certainly the vision. But there are always people. And I think one of the things that's missed the mark in this space is that people, I guess the ideological drive sometimes obscures the fact that, technology is great, but there are still people involved. There's the famous XKCD comic of, I've got, this super encryption on my phone, and then there's like, here, pay this guy the $5 rent until he tells you the code, right? Like, for this to be useful, people need to be able to interact with it in the real world. For it to reach its full potential, people need to be able to interact with it in the real world. And so I think the fact that people are focused solely on the technical issues, and they're not, oftentimes I feel, focused on a lot of maybe the business, the process issues, the personnel issues, the fact that there are real people involved in these, either building it or using it, I think is sometimes forgotten about in the dialogue. And that does open up an area of risk, right? I mean, at the end of the day, and you think about this from an insurance perspective, there's a smart contract that malfunctions. Did it malfunction because it's a bug, or did it malfunction because it was someone stealing your money, making it look like it was a bug? Yeah. And so, now you're back to interviewing people and looking at their bank accounts and seeing their flight records and seeing if they have
bad actors, or is it a mistake?
So the risks are manifold. I mean, our underwriting, we have the only, I'd say, really purpose-built and scalable underwriting that exists for this sorts of risk. And we have over 24 categories of risk, depending on what type of policies people are looking at, spanning well over 1,000 different questions. And so that's a whole another can of worms, but it is fast moving, it's dynamic, it is multifaceted. And if you focus solely on the technical risks in a very narrow sense, or even in a broader sense, you are likely to miss things, and we've seen that happen.
So you've worked with non-crypto specific, crypto specific, and DNO type insurance categories. What's the difference when you introduce a world that's on chain, like DeFi? It's purely on chain. So why does the traditional insurance landscape not quite fit, and how can we do things differently?
Yeah, so I mean, if you think about the different types of perils, so what we've generally seen are
hopefully he comes back soon. There you are.
Sorry, I'm trying to figure out if it's a camera issue or a Zoom issue. It might be a Zoom issue.
Okay.
There we go. Apologies to everyone in the audience. If it makes you feel better, I once was in a like multi-million-dollar AV suite, and people ended up taking their iPhones and passing it around for a video conference. So from an insurance perspective, there are insurance perils that are really non-crypto perils. They just have a crypto flavor, for lack of a better term. I think the most obvious one here is property insurance. So people doing mining or staking want insurance in case like there's a fire and their mining farm burns down. And the insurance is like, oh my God, it's crypto. We don't know what to do. And it's like, guys, it's just property, right? Like if you go up to them and say, hey, I've got a data center that's crunching numbers to model COVID-19, like you'd write a policy. I'm like, absolutely. Like if I say they're choosing a slightly different math problem, then all of a sudden it's an issue. Like, oh no, crypto, it's terrible. And this happened. I mean, there were miners that switched their mining hardware to, COVID-19 modeling at the beginning of the COVID pandemic. So, I mean, that's just kind of completely irrational. You see other types of products like Arizona emissions insurance, which is really about like your back office operations, your administrative processes, right? Like you put a date on the check when it comes in, or an invoice to make sure that you know that you got it on time. Even cyber insurance actually is not a crypto specific one, because all cyber policies are going to pay out crypto, or are going to exclude paying out crypto or for any crypto losses. So it's really just like, hey, like if you're breached and someone steals your customer data, which is, that is a very conventional, that is cyber risk. Really has nothing to do with crypto, but the fact that it's a crypto company, people get very nervous about. And the lack of certainty and lack of comfort that the insurance industry has precluded them from offering these sorts of coverage, even though it's no different than any other company. You then have, I'd say, D&O is kind of its own thing, because there is legitimately a crypto-specific regulatory risk. If the SEC decides they're suing you because they think you've created illegal security, then like you can't do anything about that. And so being able to have a appropriate view of the risk and how to manage it from a policy wording perspective, and making sure that it's appropriate, right, from an underwriting perspective to give the coverage that you're giving, that is a unique challenge. That's something that the insurance industry legitimately is going to have a hard time with, and it's having a hard time with. Although you're starting to see a little bit more loosening up in D&O, it's a very hard market. There aren't really a lot of good options. Then you have what I deem like the very crypto-specific risks, and those are going to be things that are theft, loss of from custody systems, or malfunctions of custody systems. With those could be centralized and decentralized, right? And so tech, failures of a smart contract or what have you. Those are hyper-specific and hyper-technical, and so those are the sorts of types of perils that we look at. We're currently doing theft, loss, and tech insurance. We plan on expanding beyond that, as well as offering some sort of crypto-denominated solutions soon. What's interesting is that from a consumer standpoint, people say, well, what, this is all crypto and Web3, why are we talking about, like, Lloyd's is what, like 400 plus years old, like, who cares? Like, we should just be Web3 and call it a day. That's not really the answer, because you still have companies that exist in the real world that have directors and officers that need insurance, that have physical operations that need insurance, and they may have centralized custody and centralized operations that need insurance. And so there really is a mix of needs where you're going to want people that have rated, licensed, admitted, very traditional insurance, backed by reinsurance. You're going to have people that are okay with maybe centralized insurance solutions, whether those are fiat or crypto denominated, but are very much conventional insurance companies, but hyper focused in the space, and again, potentially even in native cryptocurrencies. And then there is going to be a need for kind of decentralized insurance solutions, which have been wanting thus far in the space.
Tell us more about the decentralized space.
So, I mean, basically parametric risk works really well because it's objective, right? Which is you can objectively see the flight delayed. Same thing with hurricane insurance. You can see if the wind speed is above 80 miles an hour at the local weather station, and as a result, you'll just pay out the claim. The problem with theft loss is that it doesn't, like I said, it becomes ambiguous, right? Was this intentional or was it not intentional? And so in order to have a sustainable program, right, where your insurance program doesn't collapse financially, you need to make sure that you are controlling. You have to be able to control for risks, right? And so what happens is that's why you have exclusions, and that's why people do underwriting around insurance policies. What is implicitly happening with a lot of these protocols is they're either covering all the risks because they have no ability to do the underwriting or to adjust a claim afterwards because it involves things that are occurring off chain, or they're effectively covering no risk. And unlike a traditional insurance company, which doesn't want to pay out a claim because they don't want to lose money, you can't sue them, right? You just have to convince people that's in their best interest to pay out, and we've already seen that sometimes not happen. So there are these very kind of deep actuarial reasons why this stuff won't work, and then on top of it, you have kind of governance issues. Fundamentally, these were projects that were built to create tokens that appreciate in value and could be speculated on, and so that it's not about kind of meaningful. It wasn't really. At the end of the day, they're not designed for this sort of meaningful risk transference, even if it's well-intentioned, even if people were intentionally trying to build that. And so there are some deficiencies in some types of risk that are just not particularly conducive to DeFi insurance, at least the way DeFi insurance is currently being done. So again, thank you all for your patience with
We got
my
you back.
IT issue.
Yeah. So one question here is regarding the crypto market. How much security or improvement is in the crypto market? Not just safety as an investment, being an investment being a form of risk, but security against fraud and corruption. Government regulation is a hot topic. There would be taxes on people's investments also. So if not regulating crypto, what is there to help secure and protect people's investments in crypto investment?
So there's a lot to unpack in that. So there's been a lot of improvement from a securities perspective in the crypto markets, and I think, to be frank, you're even seeing these really large hacks where the industry kind of is in an ad hoc manner kind of locking the funds, and they say, hey, look, we'll pay you essentially a very large bug bounty, but give us most of the money back, and you've seen that kind of unfold quite a number of times. There's been a large improvement in, I'd say, the security of the space, but there's a very long way to go. The fraud and corruption is hard. There are a lot of anonymous developers for various reasons. There's the ability for them to, steal assets, do a rug pull, as it's colloquially known, and I think, again, this is an area where the insurance industry, I think, is going to be helpful in driving behaviors where people can, it would be hard for them to do such things in the future. I think taxes you have to pay regardless. That has nothing to do really with regulating the space or not. If you make money, the government will probably want to tax it. So based on your local laws in your jurisdiction, some people have crypto tax holidays, some people have different treatments of it. So, I'd say wherever you are, talk to a competent investment accountant who's familiar with the tax laws in your area. As far as kind of regulation, I think regulation can be very helpful. I joked and I said, I was a hardcore libertarian. I saw the 2017 kind of ICO boom and bust, got angry, and was like, we do need regulators, right? And regulations, and the regulators just kind of dropped the ball for a few years and kind of made things worse. And so I think, that regulation can absolutely be helpful. I think what has not been helpful has been the waffling. Particularly, the SEC, I think, deserves a bit of criticism on this because they've been somewhat inconsistent in what they deem to be a security and not a security. I think the CFTC was very clear about what they deem to be a commodity, and that provided a lot of clarity. The fact that the SEC either didn't give safe harbor to projects historically, or bring out clear guidelines, I think has been a real issue. I think the idea that talking to the SEC and trying to get a no action letter is like a good use of time is foolish because it's so constrained that inevitably when you change anything in your business, you're going to have to go back to them. It's too time consuming. And one of the real negative effects of this is that one of the reasons why there is no D&O insurance or very little of it is because if the SEC decides to wake up and sue you, there's really not much you can do about it. And so instead of having responsible risk managers and professionals who would want to enter the space enter it, they would say, well, I can't get D&O insurance, and I'm a smart, responsible risk professional, and so I'm not going to take a director or an officer position at a crypto project or company because you can't get D&O insurance. And I think that's had a deleterious effect. And so not that there weren't bad actors, not that there weren't people who were doing bad things, but ultimately I think that the way regulation's been approached has been really unhelpful here because you've kind of had this perverse effect where if you spoke to a lawyer and said, well, geez, should I do this? And they were a good lawyer and honest, they said, no, you shouldn't. This might be deemed a security, so you should stay out of it. And so if you're a bad actor or indifferent, you'll say, look, I don't care. I'm going to become a billionaire. If they want to find me, I'll pay $50 million fines. I'm up $1 billion anyway. And if you're a good actor, you say, well, I don't want to do that. That sounds illegal and possibly risky to people, so I'm just not going to do that. Well, okay, so guess who are the billionaires now? It's not the people that were interested in following the laws. So I think regulation, I think any action by anyone should be focused on what is it you're trying to achieve. And if you're failing to do that, maybe take a different tact. And I'm not sure that all the regulators have figured that out just yet. But we're learning and growing. And I think, I think insurance is going to be a big part of that. I think the industry is making its own strides. And I think there are some people who are making some really thoughtful conversations around how you can regulate this industry.
Absolutely. Absolutely. Well, we're going to wrap it up, and I'm going to say thank you, everyone, for joining. Thank you for your questions, and thank you, Jay, for joining us, especially today with knowing your schedule and on this day, especially. It was a really thoughtful and engaging presentation and Q&A. I hope you all enjoyed it as much as I did, and we look forward to continuing to follow Evertas. Recording of this presentation will be available over YouTube, and thanks again.
Thanks, Diana, and thanks, Yale. And looking forward to doing this again in person where I don't have to worry about microphones breaking. Bye.